Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of September 21st, 2025. And in this week's episode, it's just myself, Sprocket888, and I am going to take a look at taxes. Yes, taxes. It might seem a little bit early to start talking about taxes, but the truth is, planning for taxes when you're trading on your own is a very, very important aspect to remember. And so I'll kind of talk through some of the things that I do to prepare for taxes throughout the year to try to make the tax season a little bit more palatable come the beginning of the following year. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, a Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. Taxes, taxes, taxes. So this might not be such a big deal when you're first starting out, but as you build on your trading and as you build on profit and loss and become more and more profitable in larger and larger numbers relative to your W-2 income, this will become more and more of a thing. And so getting kind of in this habit now or early on in your trading career, I think is very important so that it just is a habit, a natural habit that you follow. And then as your portfolio grows, as your income grows, it won't ever really be a shock, and you'll kind of always be ready for that tax season as it approaches. And I, of course, have kind of come through a bunch of learnings and bumps in the road as I kind of went along. And so I have taken steps to kind of correct that. And I want to share some of those with you guys today so that you guys can kind of take that under advisement and figure out how it might apply to you. So the part that I want to kind of really start with is when you trade, your broker, your portfolio, no one is going to take care of taxes for you. It's not a thing. You're basically on your own. Whereas when you have W-2 income or things like that, your employer will withhold federal taxes. They'll submit some of that stuff throughout the year. So that's kind of like estimated taxes as they go. You know, your employer doesn't necessarily know what tax bracket you're going to fall into, but based on your salary and your W-2, that's really what they'll put you in. And so they will withhold the percentage that your salary bracket kind of will put you into. Now, there's a thing that you can fill out called a W-4 where you can make kind of adjustments on your withholding that your employer takes out. So, for example, if you and a spouse both have income, your employer doesn't know what your spouse's income is. And so you might want to make adjustments to your withholding based on that knowledge, because you will have a more complete picture of your income. And when it comes to the IRS, they really care about the complete income of who's filing. So if you're joint filing with a spouse, then you need to account for that income to figure out what tax bracket you fall into. And that tax bracket is based on your total income that comes to you. So that is short-term capital gains, that is W-2 income, that's contractor income, that's interest income from savings account. All of those things get added together, and depending on what that total number is, that will put you in a particular tax bracket with the IRS. And that is what they're expecting their percentage or their cut of when you file taxes. And so when you trade, that can be a little bit of a blind spot for some people, for many people actually. And the reason is because your trading is going to be largely variable based on market situation, market environment. And so your wins and losses and gains and everything will be very uneven throughout the year. And so there's a few different things that I have done to try to do stuff to get the right estimated taxes withheld. And I've found some things successful, some things not successful. Early on, when I first started, what I basically did was just kind of give a rough estimate of what my annual wins might be, and I kind of just adjusted my W-2 withholding in accordance to that. So I might have looked at my last year's gains and said, you know what, I'll probably have about $5,000 in gains. So I will just add that withholding to my employer W-2, because it doesn't really matter where the funds are withheld for the IRS, whether or not it's through W-2 income, whether or not it's through estimated tax payments. It doesn't really matter, because when you go to file, you tell the IRS, hey, I paid you this much money. X dollars came from my federal withholding. X dollars came from estimated tax payments. X dollars came from one-time payments, whatever it happens to be. And so this worked pretty well. I kind of just estimated what it might be. I withheld a little bit more from my W-2 income, and so I never really felt it. I was never really making extra payments. I just was kind of a dripping into that withholding from my employer paychecks. And this worked fine up to a particular point where I started not estimating correctly, where my value started getting bigger and bigger in my portfolio from gains, and it wasn't really covering. And so I would find, hey, one year I had $5,000 profit, and so I applied that to my estimation the following year, and then I found out, oh wow, actually I brought in $20,000 of profit or income, and my withholding was insufficient. And where that really hits you is when you go to file your taxes, you fill out, hey, here's all my income, here's what I withheld for you. And then they're like, oh, by the way, your income far exceeded your withholding, so you owe us a lot more money. And that can really be a sad moment when you have to pay the IRS a large chunk of payment when you file your taxes. Then what I evolved into was kind of hitting these estimated payments. And the estimated payments that I made, I would it was a little combination of looking at my actual trading time period, but also what my previous year was. And so it wasn't as systematic as what I finally arrived at, but I would say, okay, look, I made about $5,000 last year, or $10,000, or whatever that number happened to be. I would divide that by 4, at least the percentage that I would owe in taxes by 4. And then I would go ahead and take a look at what my P&L was along the way, and kind of try to tweak that a little bit and make 4 annualized payments to the IRS through the estimated payment system. And this kind of worked a little bit until, again, my portfolio and my income started getting bigger and bigger, and I started jumping basically tax brackets, because I had made the assumption that my tax bracket was going to stay the same, which I knew was kind of a flawed assessment, but I didn't realize the implications of what would happen when I added all of this kind of capital gains, short-term capital gains, to my overall income. And that's when it really hit me that also in line with that, I did a poor job kind of forecasting, I guess, the last quarter of profit and loss, because I was really looking at realized P&L along the way through my broker. And I got hit with a really, really large tax bill because I just was really under withholding because my estimations really were incorrect. So that brings me to my current system of what I've found. And I really think this is a really good system to start with, no matter how big your portfolio is, and just get in the habit of this over time. And I think it will scale and withhold the appropriate amount as you go. The only caveat to this is you do have to consider what your rough estimation of income might be, so that you can withhold or place in the appropriate tax bracket. Now, what I would recommend you do, and this is really up to each individual, is just choose the highest tax bracket and do your trading withholding in accordance with the highest tax bracket. The reason I say that is because if you do that, you definitely will not go wrong in what you withhold. Now, you might over withhold, and that could be something that is less than ideal, because what that means is that's money that you didn't have throughout the year to put forth in your trading, to put forth in interest, to do something with. Now, you'll get that money back, so it's not lost, but what you've lost is the opportunity to earn interest or trading from whatever that dollar amount happens to be. However, if you don't mind getting a large refund and you don't mind kind of foregoing that because you really don't want to ever have a large tax bill when you file your taxes, kind of putting that max tax bracket or something that's there in the calculations will kind of take care of that concern for you. So how do you pay estimated taxes? Now, this is one of the first things that I really kind of went through when I filed and was under withholding, and the IRS in my filing said, oh, you got to pay estimated taxes next year. I thought that whatever I committed to, I was obligated to hit those exact estimated tax payments quarterly, and I didn't have room or flexibility to modify that as we go. That's not true. All the IRS really wants you to do is not be under withholding by a significant number. And that's where they'll hit you with a penalty if you under withhold too much, and you actually owe too much. So it's kind of weird, but basically they're upset because they didn't get that money throughout the year, so they've missed out on the opportunity of doing something with that cash that you would have paid them. And so to kind of avoid this, what you'll do is you'll go to the IRS website, you'll register for an account to pay estimated taxes. You'll get credentials and stuff. If you've ever paid your taxes online through the IRS, it's the same site and it's the same account. So you just log in there, but instead of choosing pay my taxes, you choose pay estimated taxes. And then it says, oh, what year do you want to pay these estimated taxes for? And there's really no limit to how many times you can go in there and pay estimated taxes. You could do it weekly, you could do it monthly. I tend to do it quarterly. So the IRS has 4 times a year where they suggest that you make quarterly estimated tax payments. And so I just stick with those dates, and that's what I work into what I put in there. So I'm going to go ahead and pull up the chart of what it is that I do quarterly for my estimated trading profits. Now, pulling up the table, what you see here is I've got 4 dates that I make an IRS payment. April 15th, June 15th, September 15th, and then January 15th. Now, the January 15th is the following year. So, for example, in 2025, I made a tax payment on April 15th, 2025. I made a tax payment on June 15th, 2025, September 15th, 2025, and I will make another payment on January 15th, 2026. Prior to filing my taxes that will be due on April 15th, 2026. And what I do is I go through and I do what's called mark to market. Now, this is different than looking at just your realized P&L. So every broker should have the ability to view your statement over any custom period of time and view it as a mark to market calculation. What that means is it takes all of your holdings and assumes that you liquidate them at that moment to figure out what is the P&L. So it kind of temporarily gives you a realized P&L. So if you have a particular holding, let's say you have 100 shares in Apple, and you bought those 100 shares at $200, but it's currently trading at $230, but you still hold that position. That is an unrealized gain. However, when you do a mark-to-market accounting, it will assume that you sold them at $230, and it will give a P&L of $30 for those 100 shares. Now, what that's going to do is conservatively, it is going to give you a kind of higher expected realized gain and loss, because it's calculating your all of your positions, assuming you realize the current status of all of them. And that's important because remember I mentioned how I was not accounting for some of those unrealized gains in a particular quarter. And what happens is then that the last quarter, whenever I end up liquidating them or selling them or closing them out, there could be a very large spike, which leads to kind of an uneven application of payments in taxes. So mark to market is very important to do. Now, then I take, and I basically, for each of those payment ranges, I calculate the mark to market through my brokerage. So I just go into my brokerage. So for example, on April 15th, I went into my brokerage and I said, okay, take me from January 1st to March 31st and give me a statement mark to market. So give me my total P&L, assuming mark to market accounting for that period. And that is a number. And what I do is I then take that number, multiply it by the tax bracket that I want to apply to myself. And so I tend to choose the highest tax bracket because I would rather err on the side of withholding a little bit too much than under withholding, because I've gone through some significant under withholdings, and that's not really much fun to write that very, very large check to the IRS. So in my case, I'll use 35%, but you can choose whatever tax bracket you would like. I then multiply whatever that number is from the P&L by that 35%. That's what I make for the payment on April 15th. Now, the only thing that I don't do is if that P&L is actually negative for that quarter, I just won't make a payment. So I don't try to factor that into any previous quarter or future quarter to say, oh, here's a credit that I should apply moving forward. I just say, okay, I was negative on my P&L for that quarter. I just will not make an estimated tax payment. Now, that hasn't happened. I've had quarters where my profit is less than other quarters, but so far I have always had a positive overall P&L over a calculated period. But should I ever be negative, I simply will not make a payment, and I will not try to factor that in to some other future quarter as a credit. Now, effectively, what this should do and what it does do is it increases the amount of money that I have withheld from all of my income sources. So when I go to file taxes, in this case in 2026, I will put all of my W-2 income, I'll put all of my interest income, dividend income, capital gains income, I'll put all of that stuff in, and then it'll say, okay, I see that you have already withheld this much in your W-2 income because all of that's automatically reported to the IRS. And then it will also say, did you make any estimated tax payments? And I'll say, yes, I did. And they'll say, okay, what was your total of estimated tax payments? Now, they'll have a record of this, of course, because I paid them. But when I put it in my tax software, I'll add up all of the quarterly payments that I've made. And I'll log into the tax system to confirm what were the payments I actually made. I'll put that in there. That comes straight off credit dollar for dollar to your tax obligation. So let's say when I put all my W-2 income in, I put all my trading income, there will be a very large tax value expected to make a payment. Until I say, oh, by the way, I have already paid this dollar amount, this dollar amount, and this dollar amount. And then that will come off dollar for dollar to my tax obligation because I basically prepaid it in estimated taxes. Now, what this has typically done for me, as you might imagine, because I am calculating this, what I would consider relatively conservatively for a ability to make sure I'm withholding all that I can, because I'm doing mark to market, I'm paying taxes on unrealized gains. So if at the end of the year, those realized gains don't materialize, that basically is kind of a credit that I'll also get back. Additionally, this is taking care of all of what, because I'm choosing the highest tax bracket, should I add up all of my income sources and I actually find out I'm not in the highest tax bracket, that will be a benefit because I will have withheld as if I was in the highest tax bracket. Now, remember, all of your short-term gains are always capitalized at short-term capital gains taxes, which are equal to your income taxes. I do not trade with long-term gains and losses. It's very rare that I have any of those, so I completely ignore that in my calculation. Long-term capital gains are taxed at a different tax rate. So again, if you have some of those and you apply this methodology, you will be withholding more. So again, it's conservative from the standpoint of making sure that you're not going to be having to write a check to the IRS. And after you add all that stuff up, it really kind of helps cover it, just like you expect and have been used to coming through W-2 income, where you kind of fill out all your W-2 income. And yeah, there's a little bit of changes based on, different tax credits you might have gotten throughout the year from dependents, from energy, or whatever it happens to be. But this will put you in a very good position to not get an unexpected tax bill when you go to file your taxes. So that brings us to the end of this week's episode. Yep, it's not really tax season yet, but preparing for tax season and planning for tax season is so important when you are an individual trader, because no one else is going to be looking out for that tax withholding for you. And when when you go to file your taxes, the IRS isn't going to care that you did or didn't withhold. They're just going to add up what you owe and say, here's your bill. You have until April 15th to pay me. Thank you very much. And so to me, it is very, very important to understand what those tax implications might be and to plan for them throughout the year. Because if you fail to plan, you are almost guaranteed that you are going to fail and or be stuck with a very large tax bill, which nobody really likes that. So hopefully me sharing a little bit about how I prepare for it and how I really think getting into that habit now, no matter your portfolio size, will scale appropriately to the particular portfolio size as your portfolio grows. That methodology of the quarterly payments of mark-to-market values of your portfolio really will get you in a position or put you in a position where you will not be caught under withholding, at least from your trading income. If you have other income somewhere and you're not accounting for that, sure, you might end up with a large tax bill. But with respect to the trading income that you have, it should not put you in a position where you are in a surprise tax bill from the IRS if you follow the guidelines of the quarterly payments, mark-to-market calculations, and put yourself in the highest tax bracket when you calculate the estimated tax from the mark-to-market. So hopefully all of you are out there finding interesting trades, getting into your style, and keeping track of your P&L. If not, your broker will do it for you. Good luck out there. Have fun. And remember, think outside the block.